Hey traders, welcome back to FX Limit, where we dive deep into Forex strategies, tools, and tips to help you dominate the markets. In today's video, we're going to discuss something absolutely essential for long-term success in the Forex world: the best fundamental indicators for identifying emerging opportunities. Now, if you're serious about Forex trading, you already know that fundamentals are the backbone of long-term market movements. They provide the why behind currency fluctuations, unlike technical analysis, which tells you the when and where. So, how do we use fundamental indicators to spot emerging opportunities in the Forex market? Let's break it down. First up is interest rates. Central banks around the world use interest rates to control inflation, stabilize currency, and encourage or discourage borrowing. When a central bank raises interest rates, that usually strengthens the currency because higher interest rates attract more investors looking for better returns. So, when you hear about an interest rate hike, especially from a major economy like the US Federal Reserve or the European Central Bank, that's an early signal of potential strength in that currency. Pay attention to those announcements. If you anticipate them, you're already one step ahead. But interest rates alone aren't the whole story. Let's talk about inflation. Inflation measures the general rise in prices over time. Too much inflation, and you have a weakening currency, as its purchasing power decreases. Not enough inflation, and you could be looking at economic stagnation. The sweet spot is a moderate inflation rate, signaling steady economic growth. Keep an eye on economic reports like the Consumer Price Index, CPI, or Producer Price Index, PPI. These can be strong indicators of where inflation is headed and how currencies might respond. A lesser-known but equally powerful indicator is Gross Domestic Product, or GDP. When a country's GDP is growing, it's a sign of economic health, which typically strengthens its currency. You don't have to be glued to every GDP release, but watch out for the trend. Is the GDP consistently rising? Or is it slowing down? If the latter, you might want to prepare for potential weakening in that currency. Now, these fundamental indicators can be tricky to analyze in isolation. They often interact with each other, and sometimes one can offset the impact of another. For example, strong GDP growth might be overshadowed by rising inflation. That's where you need to keep a holistic view. This is exactly where tools like the FX Limit Apex Trend Indicator come into play. While fundamentals guide your overall strategy, the Apex Trend Indicator helps pinpoint those precise entry and exit points, combining real-time data with technical analysis. So, you could identify that the euro is set to strengthen based on fundamentals, but when should you enter the trade? The Apex Trend Indicator scans multiple currency pairs and timeframes, delivering buy and sell signals with high accuracy. It's designed to take the guesswork out of trend direction and gives you confirmation to pull the trigger when the timing is right. Okay, back to fundamentals. One of the most critical indicators for identifying emerging opportunities is the employment data. Non-farm payrolls, NFP, in the US, for instance, can shake the Forex market when released. Strong employment numbers signal economic growth, which typically leads to a stronger currency. On the flip side, weak employment figures could spell trouble for the currency. So, make sure you know the dates for employment data releases, especially for major economies like the US, the Eurozone, and Japan. Big movements can happen quickly in response to these reports. Moving on, let's talk about trade balances. Countries with a trade surplus, where exports exceed imports, tend to have stronger currencies. Why? Because a trade surplus means foreign buyers need the country's currency to purchase its exports. For example, if Germany is exporting a ton of cars to the US, American buyers will need to convert dollars into euros, boosting the euro's value. So, keeping an eye on trade balances can give you insights into long-term currency trends. Another key indicator is geopolitical events. While it's harder to quantify, geopolitical risks like elections, wars, or even trade disputes can significantly impact currencies. For instance, the uncertainty surrounding Brexit caused huge fluctuations in the British pound. If you can anticipate these events or understand their potential impact, you'll have an edge in the market. Remember, uncertainty often leads to risk aversion, and in those times, safe haven currencies like the US dollar or Japanese yen tend to strengthen. Now, fundamental analysis isn't just about reacting to news. It's about being proactive and preparing for what's coming. This is where having a systematic approach becomes crucial. You don't want to rely on gut feelings or get caught up in the hype. Instead, use the data available to you. Create a checklist of economic indicators to monitor regularly. This will not only help you stay disciplined but will also ensure that you're consistently looking for opportunities, rather than reacting to crises. While fundamental indicators are crucial, you also need a robust system to help you execute trades efficiently. That's why we developed the FX Limit Apex Trend Indicator. With its trend scanning and non-repainting buy, sell signals, you can catch market shifts faster than ever. Whether it's confirming a currency's strength after an interest rate hike or spotting a weakening trend due to falling employment numbers, the Apex Trend Indicator provides you with the actionable data you need. And it works across multiple timeframes and currency pairs, making it versatile for any trader's strategy. In conclusion, the best way to identify emerging Forex opportunities is by understanding the key fundamental indicators: interest rates, inflation, GDP, employment data, trade balances, and even geopolitical events. Combine this understanding with the precise trend signals from the FX Limit Apex Trend Indicator, and you've got yourself a powerful 1-2 punch for success. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more tips and strategies from FX Limit. Thanks for watching, and as always, happy trading.